The stock market has a massive gold problem right now because gold has been outperforming the S&P 500 by over 13% in the last year. And while everyone's been focused on SPX making new all-time highs against the dollar, against gold, it's kind of bleeding out, which is a big problem, by the way, because gold only really does this in the lead up to a recession. But look, I'm not here to call for a recession or to call for a crash. The truth is, SPX could grind higher for another year or two, and I have no idea when the next recession lands, and neither does anyone else, by the way. But my thesis isn't that stocks are going to crash tomorrow. My thesis is that gold is already winning this battle, and the smart money already knows it. So I'd rather position myself to be ready for a recession than to get caught by surprise by a recession. I mean, what would you rather? I know the answer to that. Anyway, so today we need to talk about how gold is killing the stock market. We also need to talk about why Google and Microsoft are making a huge mistake with AI and how we can benefit from that mistake. And most importantly, we need to talk about what I'm doing about gold and silver. Let's figure this out together. By the way, if you don't know me, my name's Nick. I've been a professional investor and unprofessional trader for 24 years. Before we go any further, I'm not a financial advisor. This is not an inducement to buy or sell any specific assets. And as always, do not take financial advice from some random dude on YouTube. So look, to understand exactly where we're at right now, I need to start with a little story. And I know I always start with stories, but it's because history is super important in investing. So October 9th, 2007, SPX closed at an all-time high. CNBC was in the middle of a victory lap, and the economy was being described as the strongest of a generation. I'm sure you see where this is going. Because back then, there was something happening underneath the surface that nobody on Wall Street wanted to talk about. See, that all-time high that SPX had just hit was special. It was the peak before the last recession, the dot-com bubble in the year 2000. So SPX had taken 7.5 years to make a new all-time high. Essentially, it'd been flat for almost a decade. Over that same window though, gold had gone from $260 an ounce to $750, almost 3x, right? So in the 7 years leading into the 2008 crisis, holding SPX gave you nothing in returns while gold had tripled. The chart was telling you something. It was telling you something was coming, but Wall Street wasn't because they didn't want to tell you, because they didn't want to believe themselves, I don't think. Because 17 months after that October all-time high, SPX hit $666, 666, a number befitting Wall Street, by the way. It was down 57%, and gold was at $1,000 and climbing. And there's this weird, historical quirk with markets, a pattern that to my knowledge, has never been broken. When gold outpaces SPX at this rate, shit gets bad. It gets really bad. But is that what's happening right now? Well, let's look at an actual chart to figure it out. So right now, SPX is at 7,400, 7,500, and gold is at 4,700 an ounce. The SPX to gold ratio is 1.56. What does that mean? It means one share of SPX is worth 1.56 ounces of gold. That sounds healthy for SPX, right? SPX is strong. Since 2014, the ratio has been averaging over 2, so 1.56 is actually pretty low. And in 2000, it peaked at over 5. So 1.56 is the lowest we've seen since 2014. And in 2014, it was heading up and recovering. Right now, it's heading down. The last time it was heading down towards 1.56, well, that was 2008. But something even crazier that nobody ever explains on YouTube is happening. And I guess they don't because it's boring or whatever. Maybe people don't care. I don't know. Let me know if you care. SPX has been losing value against gold for 26 years. If you actually look at this chart, SPX has lost over 70% of its value against gold since the dot-com peak. And this is a crazy fact. It blows my mind that nobody really talks about this. And do you know why it's crazy? Because SPX is up massively in dollar terms. I mean, it's making new all-time highs all the time. It keeps pumping. So how can SPX be breaking all-time highs in dollar terms, but be testing 2008 lows in gold terms? Because the US dollar is useless. Why am I getting mad? We all know this. We all know the US dollar is useless. And I mean, look, I do hold a good chunk of cash right now. I've been talking about this, but it's temporary and strategic. Generally speaking, I don't like holding US dollars. I don't like holding cash. But anyway, that's besides the point. While CNBC was telling you that this is the greatest bull market of the decade, while your 401k was printing record highs, it's all just built on a lie, really. Because a lot of those SPX pumps are fake. And I mean, look, I'm exaggerating a bit. They're not fake. The pumps are real. They're happening, and these companies are gaining value. But it's also pumping, it's amplified because the dollar is losing value at its fastest pace in history, which means that SPX goes up faster, right? Versus real money, gold, which I believe gold is real money, SPX is actually dying. Also versus silver, by the way, which I also think silver is real money, and I think silver is probably going to outpace gold over the next 10 to 20 years personally. Anyway, this brings us back to my first words of this video. The stock market has a massive gold problem. The stock market is dying versus gold, and every time this happens, my friends, every time this happens, it spells economic catastrophe. And look, I said at the start that I'm not saying that we're heading into a recession right now, or in the next year, or in the next 2 years. I don't know if we do, but I'm the kind of guy who hopes for the best and prepares for the worst. So I want to be prepared, and a recession is the worst possible thing because I don't really want it to happen. It's going to affect a lot of people very negatively. Anyway, I'm going to talk about how I'm preparing soon. Where was I? What was I saying? Yeah, so every time this happens, it's bad for the economy. 2020, 2022 are just recent examples, but the pattern goes back way longer than that. It goes back as long as SPX has existed. 1971, for example, gold was technically pegged at $35 under the gold standard. Then in 1971, Nixon closed the gold window, and over the next 9 years, gold ran from $35 all the way up to $850, a 24x in 9 years. In that same window, SPX went down. Some would argue that it went sideways. If you look at a chart, it was technically sideways. So let's call it sideways. But that's against the dollar that it went sideways. Against gold, it got annihilated. The SPX to gold ratio crashed from free down to 0.13. It's 1.56 right now. 0.13 is tiny by 1980. It got to 0.13 in 1980. So stocks lost almost everything in value against gold and against metals. Another example was the dot-com bubble. So SPX peaked at 1.5K. Gold had bottomed the previous August at $250. Over the next 18 months, SPX lost 49% of its value. Gold then started a run that would take it from $252 all the way up to $1,920 by 2011. That's a 7.5x in gold, while SPX crashed in half. The ratio compressed from over 5 to 0.7. Anyone who held SPX in real money lost almost the entire decade. And then obviously there was 2007, which I've already walked through. I'm not going to walk through it again. Look, I'm not telling you that we get a recession tomorrow. The 1973 crash took like 2 years to unfold. The 2008 crash took about a year from 2007 through to 2008 when the crash actually happened. The current setup might take 1 year, 2 years, who knows? There's a saying, the market can remain irrational longer than you can remain liquid, and the market's irrational right now. That means that this clown show might go on for a while longer. So the key is to protect yourself, but not by going short on SPX right now. So how do we actually protect ourselves? What do I do? Well, I can tell you what I'm doing, but talk to your financial advisor about this. I'm personally cutting risk. I'm reducing my SPX exposure. I'm raising my cash holdings, and I'm getting into a defensive portfolio. Now, I've been doing this for a while. I've been talking about this on this channel for a while, and it's working out really, really well. You're going to get some half-wits saying that I'm wrong because SPX is up, but gold is up more than SPX was. Silver is up more than SPX was. My energy stocks are up way more than SPX. Nike is... Well, let's forget about Nike. We'll pretend that one doesn't exist. I should have bought Under Armour. Why didn't I buy Under Armour? Why would I go for Nike? Anyway, whatever. You can't win them all. But look, honestly, I'm in good company here. Buffett is selling too. He's cashing up. He's going defensive. So let's discuss defensive positioning. Let's start with gold and silver. And I'm going to have a bit of a rant here. What happened to nuance in the world? I mean, the world has just become so black and white. There's no room for nuance. No one understands anything. I say, I like silver. I think it's going up. But if you're looking for a 500% gain from $120, you're probably looking in the wrong place because it's already pumped so much. To some people, that's as good as saying, I hate silver, do not touch it. I didn't say that. So let me make my position on silver very clear. I hold both gold and silver. They make up about 30% of my portfolio right now. I've sold a little bit. If that's not a ringing endorsement, I don't know what is. And I'm going to continue to hold them because they are an amazing protection against debasement, which when you look at the SPX to gold ratio is quite clear. If your goal is to hold an asset that protects you against debasement, gold and silver are worth looking at, especially real gold and silver that you hold in your hands. If your goal is to get a 1000% gain on silver, then it's already run, so it's probably better to look elsewhere. Got it? Now, hopefully that makes sense. Now let's talk about some other stuff. The Mag 7. They've committed hundreds of billions of dollars to AI infrastructure over the next decade. Microsoft, Meta, Google, Amazon. And while this is stupid, in my opinion, Napoleon taught us never interrupt an enemy when he's making a mistake. So their stupid mistake presents an opportunity for us. See, a lot of the money that they are spending at the moment goes into data centers that they don't even own. They sign long-term leases, often a decade or more, with these companies that build and operate the data centers. The lease is a promise. The data centers still have to get built. The cooling still has to get installed. The backup generators still have to get plugged in. The walls still need to be walled. I'm not a builder. You know what I'm saying. The point is that builders, electricians, engineers, and all the lovely people contracted to build these data centers, they are going to have to build them because it's contracted, right? And they will be building them no matter what SPX does. If SPX crashes to 70%, they're still going to have to build them. Grid equipment makers, transformer manufacturers, HVAC for cooling centers, but also just the energy providers, which is what I'm looking at mostly. And I stress here, I'm not a financial advisor. Speak to your financial advisor before making any investment decision. I'm just pointing out some stuff I'm looking at which aligns with my overall thesis. So Vistra Energy Corp, ticker VST. Their Comanche Peak nuclear plant provides carbon-free baseload power that data centers require for the 24/7 operations that they do, right? And they've secured contracts with AWS for their Comanche facility and a 20-year deal, I think, with Meta to supply power from free nuclear power plants. Then there's NextEra Energy, ticker NEE. They have plans to build 15 gigawatts of new power generation specifically for data centers by 2035. They've announced an expanded partnership with Google to co-develop multiple gigawatt scale data center campuses. Then in terms of raw materials, there's also, actually I want to say something about those stocks I mentioned. Look, again, that's not financial advice, check them out, but there's plenty of energy companies that are worth looking at. I think that energy is probably going to do well because these AI data centers and AI, it consumes a massive amount of energy. And while you could say, yeah, the AI bubble might pop, which I agree with you, I do think it's going to pop. I think it's actually sort of kind of starting to pop. It doesn't change the fact that these data centers have to be built because they're contracted to be built. So that energy is going to be consumed. Anyway, then in terms of raw materials, copper is the metal that you cannot AI your way around, right? It's in every motor, every transformer, every charging cable, every cooling loop, every electrical connection in those data centers that I've just talked about. Global copper supply is constrained. New mines take 15 to 20 years from discovery to production, by the way. Do you guys want my full thesis on copper? I'm developing a full thesis on it. I'm starting to buy up more and more copper, and I'm thinking of doing a video on it. Do you want that video? Let me know below. Now, look, I've been in this game for long enough to know that calling tops is how you go broke when you're directionally right. The markets can stay irrational longer than you can remain solvent. Like I said, the cracks that started showing in 2007 took a whole year to collapse the system. The picks and shovels trades that I'm looking at has its own risks. Long-term lease obligations are only good as long as the lease's ability to pay, right? And if the AI revenue case turns out to be weaker than expected, the lease could get renegotiated under duress. It's going to be tough for them, but it could happen. Data center construction itself has cyclical exposure to interest rates and credit conditions. Copper can sell off in a liquidity crunch even when my long-term thesis on copper is intact. Gold and silver are not linear either. They can drop 15 to 20% inside of an ongoing bull run. I mean, it has happened before. I mean, they kind of drop right now, right? Nothing is risk-free. We're all just doing our best with the information we have. If we're right, awesome. If we're wrong, then we cut our losses and before they get too bad. Anyway, guys, I'll see you in the next one.